Since 2008, foreign investors owned nearly 50% of all U.S. Treasuries. Today, that number has collapsed to just 30%. That is a $3 trillion shift quietly walking out the door. And some of that money is now landing in Canada. This is not theory. This is happening right now. If you want to understand where money really moves, stay here. Subscribe to Money Signals because the real story is always hidden. The numbers most people ignore are the ones that matter most. America's debt machine is running at a speed no one expected. By March 2026, U.S. gross debt had eclipsed $39 trillion officially. Analysts expect that number to breach $40 trillion within months. Now, that is not just a big number, it is a warning. Ray Dalio, one of the world's most respected macro investors, said it. He compared America's fiscal path to an economic heart attack coming, not a recession, a full cardiac arrest of the financial system, and the data backs him up in every single direction. In 2024, Moody's had already placed the U.S. on negative outlook. Then on May 16, 2025, the other shoe finally dropped hard. Moody's officially stripped America of its last remaining OA credit rating. The downgrade was from OA all the way down to AA1. S&P had done it in 2011. Fitch had followed in 2023. Now Moody's confirmed it. America has zero 80A ratings left anywhere. The agency cited persistent deficits and a growing debt burden directly. Federal interest payments are expected to absorb 30% of revenue by 2035. For comparison, that figure was only 9% back in 2021. That is a tripling of the interest burden in just 14 years. Moody's also pointed to a complete failure of political will to act. No administration has meaningfully addressed entitlement spending or long-term deficits seriously. The Congressional Budget Office projects debt hitting 150% of GDP by 2055. Those are numbers that would collapse any smaller country almost immediately. Now, here's where Canada enters the picture in a surprising way. When Moody's downgraded America, only 10 countries kept their AAA ratings globally. That elite list included Germany, Switzerland, Australia, Singapore, Norway, and Canada. Canada is now in more exclusive fiscal company than the United States. That matters enormously to global investors, managing trillions in sovereign bond allocations. When your benchmark safe haven loses its top rating, you start looking around. And Canada sitting at AAA suddenly looks very different on the radar. This is not about Canada being perfect. Far from it, actually. Canada carries its own debt challenges and its own fiscal pressures. Absolutely. Its federal debt stood at one conquer 27 trillion at the end of 2025. The Carn government is projecting a deficit of 78.3 billion for 2026. That marks the 10th consecutive year without a balanced federal budget there. Every baby born in Canada carries over $33,000 in federal debt. Now, but here is the critical difference that global investors are paying attention to. Canada's debt to GDP ratio remains significantly lower than America's in international comparison. The IMF ranked Canada's public finances as robust relative to other developed economies. Canada's deficit as a share of GDP sits around 1.9% for 2026. America's deficit to GDP ratio, a staggering 5.8%, more than 3 times higher. These numbers are what institutional investors run through their models every single day. When that gap widens, capital starts flowing toward the more fiscally responsible partner. And that is exactly what has been unfolding quietly throughout 2025 and 2026. The Bank of Canada's own financial stability report flagged something extraordinary in 2025. During the tariff shock of April 2025, global investors did something unusual and revealing. They dumped U.S. assets, including Treasuries and the U.S. dollar simultaneously. Historically, the dollar strengthened when markets panicked, acting as the ultimate safe haven. This time, it did not. The dollar fell with stocks during the crisis. Researchers at the Hoover Institution documented this in a formal paper afterward. They called it dollar erosion, a trend predating the tariff shock entirely. The convenience yield on U.S. Treasuries, the premium investors paid for safety, was shrinking. What had been a consistent 2% annual premium was quietly fading away fast. State Street Global Advisors confirmed the breakdown of traditional Treasury market correlations publicly. Safe haven currencies, the Japanese yen, the Swiss franc, outperformed U.S. assets. Gold, which is a major Canadian export commodity, surged dramatically in this environment. Gold in Canadian dollars rose more than 57% during 2025 alone. Verified data. JP Morgan's chief executive, Jamie Dimon, suggested gold could reach $10,000 per ounce. Eventually, gold's share of global foreign exchange reserves among emerging market central banks is doubling, and Canada is the world's fourth largest gold producer, sitting on a fortune. Canada's gold exports reached 53.3 billion in 2025, the second largest commodity export ever. Only crude oil exports exceeded gold in total Canadian export value last year. Between March and May 2025, Canada's gold exports to the UK skyrocketed 473%. Volume of those exports rose 312% over the same period just 1 year prior. That is not an accident. It is a direct response to global dollarization. As investors fled U.S. assets, they moved into gold and commodity-backed economies strongly. Canada, with its 808 rating and massive natural resource-based checks, both boxes cleanly. The RBC confirmed it in their 2025 trade analysis. Canada was diversifying powerfully. The $34.6 billion drop in Canadian exports to the U.S. was being offset. A $28.6 billion rise in exports to the rest of the world emerged. The U.S. share of Canadian total exports dropped from 76% to just 68%. Canada was finding new buyers and new investors were finding Canada simultaneously. This is the double tailwind that America's debt crisis is quietly delivering to Canada. Global instability is lifting commodity prices, and Canada is commodity rich beyond most comparisons. Dollar weakness makes Canadian resources cheaper for non-US buyers across Asia and Europe. And fiscal credibility concerns about Washington are redirecting sovereign bond flows toward Ottawa quietly. TD Economics confirmed in its February 2026 report something very telling about bond flows. Portfolio flows from the US into Canada were robust in 2025 throughout the period. Those flows came almost entirely through the debt channel. Canadian bonds attracting US capital. Foreign inward investments into Canada reached $40.6 billion as of Q3 2025 alone. That was roughly $10 billion more than over the same period in 2024. Canada was attracting more global capital precisely as America's fiscal credibility was under question, and Canadian public debt issuance hit its most active year ever by volume in 2025, $294.44 billion in issuance, surpassing even the record set the year before completely. Provincial offshore issuance alone hit a fresh record at 57.5 billion equivalent that year. That means global buyers are lining up to own Canadian debt at historic levels. The same investors stepping back from US Treasuries are stepping toward Canadian bonds instead. This is the quiet, undiscussed financial story running beneath every headline about American debt. When the world's most trusted bond market starts losing that trust, money moves fast. It moves toward stability, toward natural resources, toward AOA-rated sovereigns with credible fiscal frameworks. Right now in 2026, that description fits Canada better than it fits America. And the numbers, the real numbers from RBC, TD, the Bank of Canada confirm it. This is not speculation. This is capital allocation playing out in real time globally. The story gets deeper when you follow where the money actually goes. Canada's Trans Mountain pipeline expansion quietly changed the global energy map forever. The first full calendar year of operation was 2025, and it delivered immediately. Crude oil from Western Canada began flowing directly to Asian markets at scale. China became the primary beneficiary of this new exporting capacity right away. Singapore, South Korea, and Hong Kong absorbed additional barrels coming through that pipeline steadily. This matters because America's debt chaos is accelerating global energy diversification significantly. Countries that once relied on dollar-denominated oil markets are actively seeking alternatives now. Canada, with pipeline access to the Pacific, positioned itself perfectly for this exact moment. Indo-Pacific exports from Canada grew 4.6%, adding $5 billion in new revenue directly. That is not a rounding error. That is a structural shift in Canadian trade. And it happened precisely because US fiscal instability made dollar dependency look dangerous globally. When Washington loses credibility, trading partners quietly start building non-dollar supply chains deliberately. Canada's natural resource exports become the raw material for that strategic diversification effort worldwide. The numbers coming out of Global Affairs Canada confirm this trend is accelerating fast. Natural resource industries grew while manufacturing declined across Canada's trade-exposed sectors in 2025. Agriculture, forestry, mining, oil, and gas extraction all expanded despite broader economic headwinds. Mining and critical minerals are now at the center of a global supply scramble. America's debt problem is linked directly to its inability to fund infrastructure at home. Meanwhile, Canada is being courted by Europe, Asia, and even the United States itself for critical minerals, copper, lithium, cobalt, nickel. Canada holds extraordinary reserves globally. RBC's own thought leadership division called it a generational opportunity for Canadian resource development. The world is looking at Canada as a stable, dependable commodity supplier right now. That description is gaining power precisely because the United States looks increasingly unstable fiscally. The IMF issued a stark warning in April 2026 that deserves serious attention here. It formally acknowledged that US debt had lost its traditional safety premium over other sovereigns. The window for orderly fiscal adjustment in America is narrowing, the IMF said directly. Apollo's chief economist, Torsten Slok, added another alarming dimension to this picture entirely. Hedge funds now own a record 8% of all US Treasury securities outstanding. Their combined borrowing using those treasuries as collateral exceeds $6 trillion in leverage. Now, any forced unwind of those positions could send shockwaves through global bond markets fast. That kind of systemic fragility does not exist in the Canadian sovereign bond market. Canada's banking sector is well capitalized. Its bond market is clean. Its leverage is manageable. The OECD's 2025 Economic Survey of Canada confirmed its macroeconomic framework remains fundamentally robust. Public finances are strong enough to absorb the deterioration caused by US tariff shocks. That fiscal buffer is exactly what global investors are paying a premium to access. When the giant next door is unstable, the neighbor's stability becomes extraordinarily valuable fast. And here is something most financial commentators completely miss in this entire conversation. The Canadian dollar itself has become a beneficiary of the US dollar's weakening status. Charles Schwab's research confirmed that central banks are diversifying into smaller economy currencies actively. The Canadian dollar is explicitly listed among the currencies receiving increased central bank allocation. Global foreign exchange reserves are being rebalanced away from dollars and toward alternatives constantly. The Canadian dollar is not replacing the US dollar. Nothing is doing that. But it is receiving a larger slice of a reallocating global reserve pie steadily. Eric Brieger, director of FX and precious metals risk at silver gold bull said it clearly. When US dollar headlines cross the wire, the Canadian dollar benefits from those flows directly. Every time Washington triggers a new debt ceiling crisis, the loonie gets a quiet lift. Every time Treasury yields spike on fiscal fears, Canadian bonds look relatively more attractive. This is the silent compounding effect that America's debt crisis is delivering north of the border. It is not dramatic. It does not make front page headlines on any given day, but it shows up consistently in the capital flow data quarter after quarter now. Foreign direct investment into Canada reached $40.6 billion through Q3 2025, officially confirmed. Investment from non-US countries into Canada rose $10 billion above the prior year's pace. Canada's direct investment into non-US destinations also rose $18.9 billion year simultaneously. This is a country actively building economic relationships beyond its troubled southern neighbor deliberately, and those relationships are being built with the tailwind of US fiscal dysfunction behind them. Prime Minister Mark Carney stood at DVOS in early 2026 and called Canada a safe harbor. That was not just political rhetoric, it was a pitch to global capital directly. And the pitch is landing because the data supports it in concrete financial terms. Canada's provincial offshore bond issuance hit its highest level ever in 2025, $57.5 billion. Global buyers absorbed every dollar of it because the alternative looks increasingly uncertain and risky. Meanwhile, back in Washington, the fiscal math keeps deteriorating in ways that compound the problem. Federal interest payments absorbed 18% of government revenue in 2024, already dangerously elevated. By 2035, Moody's projects that figure will reach 30% of all government revenue consumed. For comparison, the average among AAA-rated sovereign nations is just 1.6% of revenue. America is spending nearly 12 times more of its revenue on interest than its AOA peers. That gap does not close. It widens every single year without structural reform in place. And Congress is not delivering structural reform. It is delivering more spending instead consistently. The CBO estimated the latest budget proposals would add $3 trillion in new deficits by 2034. That means the debt trajectory is not flattening. It is actively being steepened by lawmakers. Every trillion added to US debt is another argument for diversifying away from dollar assets. And Canada sits directly in the path of that diversification as a natural beneficiary position. Gold prices forecast to climb toward $4,000 per ounce by mid-2026. Canada produces it. Crude oil demand from Asia rising. Canada now has a Pacific export route for it. Critical minerals needed for the global energy transition. Canada holds some of the world's largest reserves. A AA sovereign rating maintained while America lost its last top-tier rating. Canada still holds it. Capital flows, bond issuance records, commodity export surges, currency appreciation, all pointing the same direction. None of this would be happening at this speed without America's debt crisis driving it. The dysfunction in Washington is paradoxically one of the most powerful economic forces benefiting Ottawa. This is the uncomfortable truth buried inside every debt ceiling debate and deficit projection released. When the world's reserve currency nation loses fiscal credibility, nearby stable nations absorb the overflow. Canada is absorbing that overflow, and bonds and commodities and currency and foreign investment flows. The Bank of Canada's Financial Stability Report confirmed investors appeared to diversify away from US assets. Sovereign bond yields in both countries saw large swings, but Canadian bonds held up better. Investors who traditionally fled to dollars during uncertainty instead fled to gold and alternatives in 2025. Canada produces the gold. Canada has the alternatives. Canada has the AOE rating still intact. The financial architecture of the 21st century is quietly being renegotiated in real time right now. And Canada is at the negotiating table with better cards than most people currently realize. The numbers coming out of Washington in 2020 E6 are unlike anything seen before. America's annual interest payment on its debt has crossed $1 trillion this year. In 2020, that same interest bill stood at just $345 billion annually. It has nearly tripled in 6 years, and it keeps climbing relentlessly forward. The CBO projects that number reaching $2.1 trillion per year by 2036 alone. Over the next decade, the US will spend $16.2 trillion just on interest. That is money that buys no roads, no hospitals, no defense, nothing productive. For every dollar of tax collected in 2026, 19 cents pays interest immediately. By 2036, that rises to 26 cents of every dollar collected, gone instantly. By 2048, interest becomes the single largest expenditure in the entire federal budget. It will surpass Medicare, defense, and every discretionary program Washington currently funds today. The Congressional Budget Office confirmed this trajectory, assuming current laws remain broadly unchanged, and there is no credible political consensus in Washington to change those laws. Moody's said it, the IMF said it, the CBO said it directly. The window for an orderly fiscal fix is not just narrowing, it is closing. JP Morgan Asset Management confirmed the fiscal 2026 deficit will hit 1.89 trillion. That is 5.9% of GDP, one of the highest peacetime deficit ratios ever recorded. Public debt held by creditors will reach $32.2 trillion by end of fiscal 2026. Meanwhile, Anglo American and Tech Resources announced a merger worth over $50 billion combined. The resulting company, Anglo, would be headquartered in Vancouver, Canada, as a copper giant. Sovereign wealth funds are allocating to Canadian mining names at a pace never seen. The Qatar Investment Authority invested directly in Toronto-listed Ivanhoe Mines during 2025 specifically. That is not a casual portfolio move. That is a strategic sovereign commitment to Canada. The IEA's 2026 critical minerals outlook confirmed demand is set to surge dramatically ahead. Lithium and graphite demand could rise up to 40 times by the year 2240. Canada holds enormous reserves of both, along with nickel, cobalt, copper, and rare earths. Canada's critical mineral strategy has already unlocked over $18.5 billion in investment commitments as of 2026. The Canadian government added $3.66 billion in new programs at the March 2026 PDAC convention. Over 200 mines operating across Canada produce more than 60 minerals and metals. Today, the Fraser Institute ranked Canada among the world's top jurisdictions for mining investment attractiveness. British Columbia and Ontario scored highest on geological potential and permitting improvements. Specifically, this is the infrastructure of a country quietly preparing to supply the next global economy, and it is being funded in part by capital fleeing U.S. fiscal uncertainty directly. The OECD's Global Debt Report 2026 added another dimension that deserves serious attention here. Sovereign bond debt across OECD nations is projected to reach 85% of GDP in 2026. That is the highest level since 2021, a post-pandemic record being broken again quietly. The largest driver of that increase, US dollar depreciation, inflating debt values globally. The dollar has lost nearly 10% of its value through the Trump-era turbulence period. A weaker dollar makes commodities priced in dollars more expensive for everyone else buying, but it also makes Canadian exports priced in Canadian dollars cheaper for global buyers. That currency dynamic is a direct subsidy to Canadian resource exporters from U.S. fiscal dysfunction. Every percentage point the US dollar weakens adds competitive advantage to Canadian commodity pricing globally, and the dollar's decline is not a blip. It reflects structural long-term erosion occurring. The Hoover Institution paper documented that dollar erosion predates the tariff shock of 2025 entirely. It was already happening before the trade wars, before the downgrade, before the chaos began.